Welcome. Today, we'll explore the world of financial ratios and how they help us understand a company's financial health. Whether you're a business owner, investor, or just curious, knowing how to interpret these numbers is essential. Financial ratios break down complex financial statements into simple, comparable figures. They allow us to spot trends, compare companies, and make informed decisions. In this video, we'll walk through the most important ratios, explain what they mean, and show you how to use them in real-life scenarios. Let's get started by understanding what financial ratios are and why they matter. Financial ratios are calculations that use numbers from a company's financial statements to evaluate its performance. They help us see the bigger picture by comparing different aspects of a business, such as profitability, liquidity, and efficiency. By analyzing these ratios, we can quickly assess how well a company is doing without getting lost in pages of numbers. Think of ratios as shortcuts that summarize key information. In the next scenes, we'll break down the main types of financial ratios and what each tells us about a business. There are several categories of financial ratios, each serving a different purpose. The main types include liquidity ratios, profitability ratios, efficiency ratios, solvency ratios, and market value ratios. Each category focuses on a specific aspect of a company's financial health. For example, liquidity ratios measure the ability to pay short-term debts, while profitability ratios show how well a company generates profit. Understanding these categories helps you know which ratios to use in different situations. Let's dive deeper into each type, starting with liquidity ratios. Liquidity ratios help us understand if a company can meet its short-term obligations. These ratios are crucial for creditors and investors who want to know if the business can pay its bills on time. The two most common liquidity ratios are the current ratio and the quick ratio. Both use information from the balance sheet to assess short-term financial strength. A higher ratio generally means better liquidity, but too high might indicate unused resources. Next, we'll look at how to calculate and interpret the current ratio. Current ratio is calculated by dividing current assets by current liabilities. This ratio shows how many times a company's short-term assets can cover its short-term debts. For example, a current ratio of 2 means the company has twice as many assets as liabilities due within a year. While a higher ratio is generally good, an extremely high number could mean the company isn't using its assets efficiently. Let's see how this ratio works with a simple example in the next scene. Imagine a company with $100,000 in current assets and $50,000 in current liabilities. The current ratio would be 2. This means the company can pay its short-term debts twice over. Investors and creditors often look for a current ratio above 1, but what's ideal can vary by industry. If the ratio is too low, it could signal trouble paying bills. If it's too high, the company might not be investing its assets well. Next, we'll look at the quick ratio for a more stringent test of liquidity. Quick ratio, also known as the acid test ratio, is a stricter measure of liquidity. It excludes inventory from current assets, focusing only on the most liquid assets like cash, marketable securities, and receivables. This ratio tells us if a company can meet its short-term obligations without selling inventory. A quick ratio above 1 is usually considered healthy, but again, what's ideal depends on the industry. Let's see how to calculate the quick ratio in the next scene. Calculate the quick ratio. Subtract inventory from current assets, then divide by current liabilities. For example, if a company has $100,000 in current assets, $30,000 in inventory, and $50,000 in current liabilities, the quick ratio is 100,000 30,000 / 50,000 equals 1.4. This means the company has $1.40 in liquid assets for every $1 of short-term debt. This ratio is especially important for businesses where inventory isn't easily converted to cash. Profitability ratios measure how well a company generates profit relative to its sales, assets, or equity. These ratios are key for investors who want to know if a business is making money efficiently. Common profitability ratios include gross profit margin, net profit margin, return on assets (ROA), and return on equity (ROE). Each ratio highlights a different aspect of profitability. Let's start by looking at the gross profit margin and what it tells us about a company's core business. Gross profit margin shows the percentage of revenue that exceeds the cost of goods sold. It's calculated by subtracting the cost of goods sold from revenue, then dividing by revenue. A higher gross profit margin means the company keeps more money from each sale after covering production costs. This ratio helps us understand how efficiently a company produces its goods or services. Next, we'll see how to interpret this ratio with a practical example. Suppose a company earns $200,000 in revenue and its cost of goods sold is $120,000. The gross profit is $80,000. To find the gross profit margin, divide $80,000 by $200,000, which equals 0.4 or 40%. This means the company keeps 40 cents of every dollar in sales after paying for production costs. A higher margin is generally better, but it's important to compare with industry averages. Next, let's look at the net profit margin for a broader view of profitability. Profit margin takes the analysis further by considering all expenses, not just production costs. It's calculated by dividing net income by revenue. This ratio shows how much profit a company keeps from each dollar of sales after all expenses, including taxes and interest. A higher net profit margin means the company is managing its costs well. Let's see how this ratio is calculated with a real-world example in the next scene. Imagine a company with $200,000 in revenue and $180,000 in total expenses. The net income is $20,000. To calculate the net profit margin, divide $20,000 by $200,000, which equals 0.1 or 10%. This means the company keeps 10 cents of every dollar in sales after all expenses. Comparing net profit margins across companies helps investors spot the most efficient operators. Next, we'll discuss return on assets (ROA) and why it matters. Return on assets, or ROA, measures how effectively a company uses its assets to generate profit. It's calculated by dividing net income by total assets. A higher ROA indicates that the company is making good use of its resources. This ratio is especially useful when comparing companies in the same industry. Let's see how to interpret ROA with a simple example in the next scene. Suppose a company has a net income of $30,000 and total assets of $300,000. The ROA is $30,000 divided by $300,000, which equals 0.1 or 10%. This means the company generates 10 cents of profit for every dollar of assets. A higher ROA is generally better, but it's important to compare with similar companies. Next, we'll look at return on equity (ROE) and how it measures shareholder return. Return on equity, or ROE, measures how effectively a company uses shareholders' equity to generate profit. It's calculated by dividing net income by shareholders' equity. A higher ROE means the company is delivering better returns to its owners. This ratio is especially important for investors who want to see how well their money is being used. Let's see how to calculate and interpret ROE in the next scene. Imagine a company with a net income of $40,000 and shareholders' equity of $200,000. The ROE is $40,000 divided by $200,000, which equals 0.2 or 20%. This means the company generates 20 cents of profit for every dollar of equity. A higher ROE is generally better, but it's important to compare with industry peers. Next, let's move on to efficiency ratios and see how they measure operational performance. Efficiency ratios show how well a company uses its assets and manages its operations. Common efficiency ratios include inventory turnover, accounts receivable turnover, and asset turnover. These ratios help us see how quickly a company turns resources into sales or cash. High efficiency ratios usually indicate effective management. Let's start by looking at inventory turnover and what it reveals about a company's operation. Inventory turnover measures how many times a company sells and replaces its inventory during a period. It's calculated by dividing the cost of goods sold by average inventory. A higher turnover means inventory is sold quickly, which is usually a good sign. However, too high a turnover could mean the company is running out of stock too often. Let's see how to interpret this ratio with an example in the next scene. Suppose a company has a cost of goods sold of $150,000, an average inventory of $30,000. The inventory turnover ratio is $150,000 divided by $30,000, which equals 5. This means the company sells and replaces its inventory 5 times a year. Comparing the ratio with industry averages helps determine if the company is managing inventory efficiently. Next, let's look at accounts receivable turnover. Accounts receivable turnover measures how quickly a company collects payments from customers. It's calculated by dividing net credit sales by average accounts receivable. A higher ratio means the company collects cash faster, which is good for cash flow. However, if the ratio is too high, it could mean the company has strict credit policies that might hurt sales. Let's see how this ratio works with an example next. Imagine a company with $120,000 in net credit sales and $20,000 in average accounts receivable. The accounts receivable turnover ratio is $120,000 divided by $20,000, which equals 6. This means the company collects its average receivables 6 times a year. Comparing this ratio to industry norms helps assess credit and collection policies. Next, let's look at asset turnover and what it reveals about a company's use of assets. Asset turnover measures how efficiently a company uses its assets to generate sales. It's calculated by dividing net sales by average total assets. A higher asset turnover means the company is generating more sales per dollar of assets. This ratio is especially useful for comparing companies in asset-heavy industries. Let's see how to interpret this ratio with an example in the next scene. Suppose a company has $500,000 in net sales and $250,000 in average total assets. The asset turnover ratio is $500,000 divided by $250,000, which equals 2. This means the company generates $2 in sales for every $1 of assets. Comparing this ratio with industry averages helps assess operational efficiency. Next, let's move on to solvency ratios and see how they measure long-term financial stability. Solvency ratios measure a company's ability to meet its long-term obligations. These ratios are important for investors and creditors who want to know if the business can survive over the long haul. Common solvency ratios include the debt-to-equity ratio and the interest coverage ratio. Let's start by looking at the debt-to-equity ratio and what it tells us about a company's financial structure. Debt-to-equity ratio compares a company's total liabilities to its shareholders' equity. It's calculated by dividing total liabilities by shareholders' equity. A higher ratio means the company is using more debt to finance its operations, which can increase risk. However, some industries naturally have higher debt levels. Let's see how to interpret this ratio with an example in the next scene. Suppose a company has $300,000 in total liabilities and $200,000 in shareholders' equity. The debt-to-equity ratio is $300,000 divided by $200,000, which equals 1.5. This means the company uses $1.50 of debt for every $1 of equity. A higher ratio can signal higher risk, but it's important to compare with industry standards. Next, let's look at the interest coverage ratio and why it matters. Interest coverage ratio measures a company's ability to pay interest on its debt. It's calculated by dividing earnings before interest and taxes, EBIT, by interest expense. A higher ratio means the company can easily cover its interest payments, which is a sign of financial strength. If the ratio is too low, the company may struggle to meet its debt obligations. Let's see how to calculate this ratio with an example next. Imagine a company with EBIT of $60,000 and interest expense of $15,000. The interest coverage ratio is $60,000 divided by $15,000, which equals 4. This means the company earns 4 times its interest expense, indicating strong financial health. A ratio below 1.5 could be a warning sign. Next, let's move on to market value ratios and see how they help investors assess a company's stock. Market value ratios help investors evaluate a company's stock price relative to its earnings, book value, or sales. Common ratios include the price to earnings (PE) ratio, price to book (PB) ratio, and price to sales (PS) ratio. These ratios are especially important for investors deciding whether a stock is undervalued or overvalued. Let's start by looking at the PE ratio and what it tells us. Price to earnings, or PE ratio, compares a company's stock price to its earnings per share. It's calculated by dividing the market price per share by earnings per share. A high PE ratio can mean investors expect high growth, while a low PE might signal undervaluation or slow growth. Let's see how to interpret this ratio with an example in the next scene. Suppose a company's stock is trading at $50 per share and its earnings per share are $5. The PE ratio is $50 divided by $5, which equals 10. This means investors are willing to pay $10 for every $1 of earnings. Comparing PE ratios across companies helps investors spot growth opportunities or potential bargains. Next, let's look at the price-to-book ratio. Price to book, or PB ratio, compares a company's stock price to its book value per share. It's calculated by dividing the market price per share by book value per share. A low PB ratio can mean the stock is undervalued, while a high PB might indicate overvaluation. Let's see how to interpret this ratio with an example next. Imagine a company's stock is trading at $30 per share, and its book value per share is $15. The PB ratio is $30 divided by $15, which equals 2. This means investors are paying $2 for every $1 of book value. Comparing PB ratios across companies helps identify undervalued or overvalued stocks. Next, let's look at the price-to-sales ratio. Price-to-sales, or PS ratio, compares a company's stock price to its revenue per share. It's calculated by dividing the market price per share by revenue per share. A low PS ratio can indicate undervaluation, while a high PS might signal high growth expectations. Let's see how to interpret this ratio with an example in the next scene. Suppose a company's stock is trading at $20 per share, and its revenue per share is $5. The PS ratio is $20 divided by $5, which equals 4. This means investors are paying $4 for every $1 of revenue. Comparing PS ratios across companies helps spot undervalued or overvalued stocks. Next, let's discuss how to use financial ratios together for a complete analysis. A single ratio gives a complete picture of a company's financial health. It's important to use multiple ratios together to get a well-rounded view. For example, a company might have strong profitability but weak liquidity. By looking at liquidity, profitability, efficiency, solvency, and market value ratios together, you can make more informed decisions. In the next scenes, we'll look at how to analyze ratios over time and compare them with industry benchmarks. Trend analysis involves looking at financial ratios over several periods to spot patterns. Are ratios improving, declining, or staying the same? This helps identify strengths and weaknesses in a company's performance. For example, a rising current ratio might signal improving liquidity, while a declining profit margin could be a red flag. Let's see how to perform trend analysis in the next scene. Suppose a company's current ratio was 1.2 last year, 1.5 this year, and 1.8 next year. This upward trend suggests improving liquidity. On the other hand, if the net profit margin drops from 15% to 10% to 8%, it could signal rising costs or declining sales. Tracking ratios over time helps spot positive or negative trends early. Next, let's discuss benchmarking and why it's important. Benchmarking means comparing a company's ratios with industry averages or competitors. This helps determine if the company is performing above or below the norm. For example, a higher ROE than the industry average is usually a good sign. Benchmarking also helps set performance targets and identify areas for improvement. Let's see how to use benchmarking in practice in the next scene. Suppose the average ROE in an industry is 12%, but a company's ROE is 18%. This suggests the company is outperforming its peers. On the other hand, if its current ratio is below the industry average, it might need to improve liquidity. Benchmarking helps managers and investors set realistic goals and spot competitive advantages or weaknesses. Next, let's talk about the limitations of financial ratios. While financial ratios are useful, they have limitations. Ratios rely on accurate financial statements, and accounting methods can vary between companies. Some ratios may not be relevant for all industries. External factors like economic conditions can also impact ratios. It's important to use ratios as one part of a broader analysis, not the only tool. Next, let's see how to avoid common mistakes when interpreting ratios. Common mistake is relying on a single ratio or ignoring industry differences. It's also easy to overlook changes in accounting policies or economic conditions that affect ratios. Always use multiple ratios, compare with industry benchmarks, and consider the bigger picture. Being aware of these pitfalls helps you make better financial decisions. Next, let's summarize what we've learned about interpreting financial ratios. Covered the main types of financial ratios, how to calculate and interpret them, and why they matter. Remember, ratios help simplify complex financial data and reveal important trends. Use multiple ratios, analyze trends over time, and benchmark against industry standards for the best results. Understanding financial ratios is a powerful skill for making informed business and investment decisions. In our final scene, let's look at how you can apply this knowledge in real life. Now that you know how to interpret financial ratios, try applying them to real companies or your own business. Review financial statements, calculate key ratios, and compare them over time or with industry peers. This hands-on approach will deepen your understanding and help you make smarter financial decisions. Remember, financial ratios are tools, use them wisely and always consider the bigger picture. Thanks for joining us on this journey through financial ratio analysis.